welcome to this podcast where I'm going to be looking at partnerships, appropriation accounts and current accounts. Okay, little bits of theory that we need to do very quickly. Key terms, salary. Okay, it's not like a worker's salary, that's a share of profit that's given to a partner, normally for hours worked in the business. It's not money taken out of the business, it's an entitlement to take some money out as drawings in the future. Interest on capital, that's a reward for investing in the business in the long term, so the more money you put in, the bigger the interest on capital that you receive for the profit. The profit share itself is a split of any adjusted profit in an agreed proportion between owners of the business. Interest on drawings is a penalty. It's money it's profit that partners have to give back for taking money out early as drawings, and it penalises them for effectively taking that money out early and potentially leaving the business without spare cash. And drawings is obviously the same as a sole trader. It's the money physically taken out of a business. Appropriation account, what is it? Well, it's just an account that's done at the end of the income statements, and it shows how the profit for the year is split between partners. In a question, you will be given the information that you require to work through. That is we're working through doing an appropriation account. The first one that we need to do always, and it's the only one that gets added on, is add interest on drawings. So what we're effectively doing, we're saying there's more profit to be shared because of the interest on drawings. The interest on drawings here is $400 and $200. So if we add them together, we get $600, and therefore the total interest on drawings taken out is $600. That now means because we're going to add the interest on drawings on, that we've actually got $40,600 to split between the partners. Looking up here, one of the partners only, which is Alia, is entitled to a salary. That's probably because Alia does more work in the business, whereas Ria is entitled to no salary. So the total amount of salary that needs to be taken out of this profit before we work at a profit share ratio is $2,000. And on the interest on drawings, well, we're told that they're going to get 2% interest on capital. We're told that they're going to get 2% interest on capital. 2% of 100,000 is 2,000. 2% of 50,000 is 1,000, and therefore the total that we're going to take out is $3,000. When we take those two out, the profit left to be sharing between the partners is $35,600. What we then need to do is to work out what we're going to do with that $35,600. Well, the profit share ratio is 3 to 2. So between the partners, they're going to have a total of 5 profit shares. We then find out one profit share, and one profit share is going to be the profit available to share, $35,600 divided by the total profit shares. And that gives us $7,120 as a profit share. And then for each partner, what we need to do is to multiply one share by the number of shares they are entitled to take out. Alia, 7 shares, so she's entitled to 21,360. And Ria is entitled to 2 profit shares, so Ria is entitled to $14,240. Just a quick double check down here at the bottom. Okay, the total of the profit shares equals the profit available for distribution, so we haven't made an error. Question here for you to have a go at, and then come back just to have a look at what we're going to do with the current account. Okay, welcome back. The current account. It's not a particularly difficult thing to do. You'll be giving an opening balance. In this case, we're giving an opening balance. It's a credit entry for Alia. So just let's have a look where that goes. It goes on the credit side, as you'd expect. And what that means is that Alia hasn't taken out all of the profit she was entitled to at the start of the year from previous years. So Alia is actually owed $1,200 by the business, whereas Ria's not been quite so good. Ria has a debit balance, and what that means is that Ria is actually taking out $100 too much. Okay, so Ria, if the business was to cease trading on the 1st of October 2015, would have had to have put $100 into the business. Look at where the interest on drawings goes. Well, what we do with that, we treat it as if they've taken out extra money. So they've taken out some of the profit share they were entitled to. So if there'd been none of the other appropriations of profit, RIA now would have owed the business $300. And in reality now we're saying that ALIA only has $800 that the business owes to her. All the others, they go on the credit side because it's all extra money the partners are entitled to take out. So the salary goes in there because ALIA is now entitled to take out $2,000 as drawings from the business. The interest on capital goes in, meaning that ALIA can also take out $200 as drawings because of the interest on her extra capital, and RIA only $1,000, and then we put in the profit share. Okay. Now I know with this one that the credit side is now going to be bigger for both of the partners. Partly because I wrote the question, so it makes it easy for me, and therefore I need to make the debit side the same as the credit side. Okay, I now need to put in the drawings, and in this case the drawings are given in the question, which again you'll find in an exam question, and we've got 20,000 for ALIA, 10,000 for RIA. So I make the debit side the same size as the credit side. And what I now need to do is to work out my balances carried forward. Well, if I do 21,360, take 20,000, take 400, I get $960. I do the same calculation over here for RIA, do 14,240, take 10,000, take 200 and take 100, I get 3,940. I put in my balance brought forwards, make sure that the balance brought forward is on the first day of the next financial year, and I've completed my current account. For those of you, and it should be all of you really, certainly I teach you, who've looked at cash accounts before, this layout is exactly the same as we've done in the past for both cash and to a degree for petty cash. So ALIA has a debit column and a credit column, RIA has a debit column and a credit column, and we do all RIA's entries in the RIA account, and we do all ALIA's entries in the ALIA account. Okay, you guys now go back to the original set of questions, and what you need to do is to put the information into the current account, and obviously send it back to me and I will mark it. Thanks for being a great audience, and I will speak to you all again soon.